You're going to pay more in taxes this year than you need to. You're probably not doing anything wrong. You're also not being careless. But the tax code is designed in a way that rewards people who know specific moves and silently penalizes everyone who doesn't. Here's what's frustrating. The strategies that could save you hundreds or thousands of dollars aren't secrets. They're written into the tax code, available to anyone. But most people never learn them. They file their taxes the same way every year, take the standard deduction, and assume they're getting everything they're entitled to. They're not. And the money they're leaving on the table compounds year after year into tens of thousands of dollars over a lifetime. Money that could have been invested, could have been earning returns, could have been building actual wealth instead of subsidizing government programs you'll never benefit from. The IRS isn't going to call you and suggest you claim a credit you missed. Your employer isn't going to remind you about the retirement account strategy that could cut your tax bill by thousands. Nobody is looking out for your tax situation except you. This video covers 13 tax moves that can still save you money in 2026. Strategies that range from obvious but underused to genuinely obscure. Some of them you can implement today. Some require planning for next year. All of them are legal, available to regular people, and dramatically underutilized. If you've ever felt like the tax system is rigged against normal people, you're partially right. But the rigging works both ways, and these are the moves that tilt things back in your favor. The first move is maximizing contributions to your 401k or equivalent employer-sponsored retirement plan. This is the most powerful tax reduction tool available to most working Americans, and it's still underutilized despite being discussed constantly in financial media. Here's why it matters. Every dollar you contribute to a traditional 401k reduces your taxable income by that same dollar. If you're in the 22% federal tax bracket, a $10,000 contribution saves you $2,200 in federal taxes immediately, plus whatever your state income tax rate adds. The contribution limit for 2026 is $23,500 if you're under 50. If you're 50 or older, you can contribute an additional $7,500 in catch-up contributions, bringing your total to $31,000. Most people contribute whatever percentage gets them the employer match and stop there. That's leaving money on the table. Every additional dollar you contribute above the match still reduces your taxes. You're just not getting the bonus of employer matching on top. If you can't max out completely, increase your contribution by 1% every time you get a raise. You'll barely notice the difference in take-home pay, but the tax savings compound significantly over time. The math is straightforward. Someone in the 24% bracket who increases their contribution by $3,000 saves $720 in federal taxes alone. That's real money that would otherwise go to the government instead of your future. The second move is contributing to a health savings account if you have access to one. HSAs are the most tax-advantaged account in the entire tax code, and most people who have access to them either don't use them or don't use them strategically. An HSA offers triple tax benefits. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. No other account in existence offers all three. To qualify, you need to be enrolled in a high-deductible health plan. In 2026, that means a plan with at least a $1,600 deductible for individual coverage or $3,200 for family coverage. The contribution limits for 2026 are $4,300 for individual coverage and $8,550 for family coverage. If you're 55 or older, you can add another $1,000 in catch-up contributions. Here's the strategic move most people miss. You don't have to spend your HSA funds on current medical expenses. You can pay medical costs out of pocket, let your HSA grow invested in index funds, and withdraw decades later for medical expenses in retirement, when healthcare costs are highest and your tax situation may be different. The HSA essentially becomes a stealth retirement account with better tax treatment than either a 401k or Roth IRA. A dollar contributed at age 30 and invested for 35 years could grow to over $10, all completely tax-free if used for medical expenses. If your employer offers HSA contributions, that's additional free money beyond your 401k match. Many people overlook this because it's in a different benefits section from retirement accounts. The third move is understanding when to itemize versus taking the standard deduction. The standard deduction for 2026 is $15,700 for single filers and $31,400 for married filing jointly. If your itemized deductions exceed these amounts, you should itemize. If they don't, take the standard deduction. This seems obvious, but the strategic opportunity is in pushing yourself over the itemization threshold through timing. Here's how it works. Instead of making charitable donations every year, bunch 2 or 3 years' worth of donations into a single year. In the bunching year, your itemized deductions exceed the standard deduction and you itemize. In the other years, you take the standard deduction. Example, you normally donate $4,000 annually to charity. Over 3 years, that's $12,000 in donations. But spread evenly, it never pushes you over the itemization threshold. Instead, donate $12,000 in year 1 and nothing in years 2 and 3. Year 1, your itemized deductions are significantly higher. Years 2 and 3, you take the standard deduction as usual. Same total donations, but higher total deductions across the 3-year period. This strategy works with any deductible expense you can control the timing of: charitable donations, medical procedures that aren't urgent, prepaying property taxes in certain situations. The key is running the numbers. Most people don't because it requires comparing scenarios, and that requires knowing what you're comparing. This single calculation, done once per year, can be worth hundreds or thousands in tax savings. The fourth move is tax loss harvesting in your investment accounts. If you have investments in taxable brokerage accounts, not retirement accounts, but regular investment accounts, you can use losing positions to offset gains and reduce your tax bill. Here's how it works. When you sell an investment for more than you paid, you have a capital gain, which is taxable. When you sell for less than you paid, you have a capital loss. Losses can offset gains dollar for dollar, eliminating the tax on those gains. If your losses exceed your gains, you can deduct up to $3,000 of excess losses against ordinary income each year. Any remaining losses carry forward to future years indefinitely. The strategy is to periodically review your taxable accounts for positions that are down, sell them to realize the loss, and immediately purchase a similar but not identical investment to maintain your market exposure. The wash sale rule prevents you from claiming the loss if you buy a substantially identical security within 30 days before or after the sale. So you can't sell an S&P 500 index fund, claim the loss, and immediately buy the same fund back. But you can sell an S&P 500 fund and buy a total stock market fund. Similar exposure, different fund, loss preserved. With market volatility common in 2026, most portfolios have positions that are down, even if the overall portfolio is up. Those losing positions are tax assets waiting to be harvested. Many people overlook this because keeping track of cost basis and gains across multiple accounts feels complicated, but this is precisely where the effort pays off. Small optimizations across different parts of your financial life add up to significant savings over time. The fifth move is contributing to a Roth IRA even when you think you can't. The Roth IRA income limits for 2026 are $165,000 for single filers and $240,000 for married filing jointly. Above these thresholds, direct Roth contributions aren't allowed. But the backdoor Roth IRA strategy works for everyone, regardless of income. Here's the process. Contribute to a traditional IRA, no income limits for contributions, just for deductibility. Then immediately convert that traditional IRA to a Roth IRA. You'll owe taxes on any gains between contribution and conversion, but if you convert immediately, there are essentially no gains to tax. The contribution limit for IRAs in 2026 is $7,000, or $8,000 if you're 50 or older. That's $7,000 annually that can grow completely tax-free for decades. One important note: the backdoor Roth works cleanly only if you don't have other traditional IRA balances. If you do, the pro rata rule applies, and part of your conversion will be taxable based on the ratio of pre-tax to after-tax money across all your IRAs. If you have old traditional IRA balances, consider rolling them into your current 401k, if your plan allows, to clear the path for clean, backdoor Roth conversions going forward. This strategy has been scrutinized by Congress repeatedly, but remains legal and available in 2026. There's no guarantee it will exist forever, which makes using it now even more valuable. The sixth move is claiming education tax credits if you or your dependents are in school. The American Opportunity Tax Credit provides up to $2,500 per eligible student for the first 4 years of higher education. It's partially refundable, meaning you can receive up to $1,000 even if you owe no taxes. The Lifetime Learning Credit provides up to $2,000 per tax return for any post-secondary education, including graduate school, professional degrees, and courses to improve job skills. No limit on years. You can claim it indefinitely as long as you're taking qualifying courses. Income limits apply. The American Opportunity Credit phases out between $80,000 and $90,000 for single filers and $160,000 to $180,000 for married filing jointly. The Lifetime Learning Credit phases out at lower income levels. Qualified expenses include tuition, fees, and required course materials. Room and board don't qualify. Here's what many people miss. If you're paying for a dependent's education, you claim the credit, not the student. And you can claim the American Opportunity Credit for up to 4 students simultaneously if you have multiple children in college. The American Opportunity Credit alone is worth up to $10,000 over 4 years of college per student. That's $10,000 you either get back or don't pay in the first place. Significant money that many families miss because they don't realize they qualify. The seventh move is taking the Savers Credit if your income qualifies. This is one of the most overlooked tax credits because it's only available to people with lower incomes. But for those who qualify, it's essentially free money for saving. The Savers Credit provides a credit of up to $1,000 for individuals or $2,000 for married couples who contribute to retirement accounts. The credit is a percentage of your contribution, 50%, 20%, or 10%, depending on your income. For 2026, the income limits for the maximum 50% credit are approximately $23,000 for single filers and $46,000 for married filing jointly. Higher income levels qualify for smaller percentage credits, phasing out entirely around $38,000 single and $76,000 married. This credit is in addition to the tax deduction you get from traditional retirement account contributions. So if you contribute $2,000 to a traditional IRA, you get both the deduction, reducing your taxable income, and a potential credit of up to $1,000 on top. If you're early in your career, working part-time, or have income in these ranges for any reason, the Savers Credit dramatically increases the benefit of retirement saving. A $2,000 IRA contribution might cost you only $500 after the deduction and credit, a 75% effective discount on retirement savings. The eighth move is understanding the 0% capital gains bracket. Most people know that long-term capital gains, gains on assets held more than 1 year, are taxed at lower rates than ordinary income. What fewer people realize is that there's a 0% bracket for capital gains. In 2026, single filers with taxable income up to approximately $48,000 and married couples filing jointly up to approximately $96,000 pay 0% federal tax on long-term capital gains. This creates opportunities for strategic gain realization. If your income is below these thresholds, you can sell appreciated assets, pay no federal capital gains tax, and reset your cost basis to the current higher value. Consider this scenario. You bought stock for $10,000 that's now worth $20,000. If you sell in a year when your income exceeds the 0% threshold, you'll owe 15% on the $10,000 gain, $1,500 in federal taxes. But if you sell in a year when your income is below the threshold, maybe you're between jobs, took a sabbatical, retired early, or just had a lower income year, you pay zero on that same gain. Then you can immediately repurchase the stock at the new $20,000 cost basis. This is particularly powerful for early retirees living on savings before Social Security begins, people taking career breaks, or anyone with temporarily reduced income. The ninth move is maximizing the child tax credit. The child tax credit for 2026 provides up to $2,000 per qualifying child under 17. This directly reduces your tax bill, not your taxable income, but your actual tax owed. Up to $1,600 per child is refundable, meaning you can receive it even if you owe no taxes after other deductions and credits. Income limits are generous. The credit begins phasing out at $200,000 for single filers and $400,000 for married filing jointly. Most families with children qualify for the full amount. Here's what some families miss. The credit is per child. 3 children means up to $6,000 in credits, a significant reduction in your tax bill. And because much of it is refundable, even families with low tax liability can benefit substantially. The documentation requirement is straightforward. The child must have a Social Security number and meet dependency tests. But ensuring all qualifying children are claimed, especially in complex custody situations, is worth reviewing carefully. The 10th move is claiming energy efficiency credits for home improvements. The Residential Clean Energy Credit and the Energy Efficient Home Improvement Credit both offer substantial tax savings for qualifying upgrades to your home. The Residential Clean Energy Credit covers solar panels, solar water heaters, wind turbines, geothermal heat pumps, and battery storage. The credit equals 30% of the cost with no dollar cap. A $20,000 solar installation generates a $6,000 tax credit. The Energy Efficient Home Improvement Credit covers more modest upgrades: energy-efficient windows, doors, insulation, heat pumps, water heaters, and electrical panel upgrades. Annual limits apply, typically $1,200 total per year for most improvements, with higher limits for heat pumps and biomass stoves. These credits make improvements that were borderline financially sensible into clearly good investments. A heat pump that might have a 12-year payback based on energy savings alone has a much shorter payback when you factor in the $2,000 tax credit. If you've made qualifying improvements in 2026 and haven't accounted for these credits, you're leaving money on the table. If you're planning improvements, timing them to maximize credit utilization across multiple years can increase your total benefit. The 11th move is deducting medical expenses that exceed the threshold. Medical expenses are deductible to the extent they exceed 7.5% of your adjusted gross income. For most people in most years, this threshold is too high to provide any benefit. But in years with major medical events, the deduction can be substantial. If your AGI is $80,000, the threshold is $6,000. Any medical expenses above $6,000 become deductible. Qualifying expenses include obvious costs like surgery, hospitalization, and prescription medications, but also less obvious ones: dental work, vision correction including LASIK, mental health treatment, fertility treatments, medical equipment, and even travel costs to receive medical care. Insurance premiums paid with after-tax dollars also qualify, including Medicare premiums, long-term care insurance premiums with age-based limits, and COBRA coverage. If you're facing a year with significant medical costs, consider timing discretionary medical expenses, elective procedures, dental work you've been postponing, new glasses or contacts, into the same year to maximize what exceeds the threshold. This is another area where actively looking for savings across different parts of your financial life pays off. The expenses are happening regardless. The only question is whether you're capturing the available tax benefit. The 12th move is claiming the home office deduction if you're self-employed. Employees working remotely can't claim this deduction. That benefit ended after 2017. But self-employed individuals, freelancers, and business owners can still deduct home office expenses. The simplified method allows a deduction of $5 per square foot of dedicated home office space, up to 300 square feet, a maximum $1,500 deduction with minimal record keeping. The regular method requires calculating actual expenses, mortgage interest or rent, utilities, insurance, repairs, and allocating them based on the percentage of your home used for business. This method often produces larger deductions, but requires detailed records. To qualify, the space must be used regularly and exclusively for business. A desk in the corner of your bedroom that you also use for personal activities doesn't count. A converted spare room used only as your office does. The deduction reduces self-employment income, which means it saves both income tax and self-employment tax, a combined rate that can exceed 30% for many self-employed individuals. If you're self-employed and working from home without claiming this deduction, you're overpaying your taxes every single year. The deduction isn't large for everyone, but over a career of self-employment, even $1,500 annually compounds into significant money. The 13th move is making charitable donations strategically, including often overlooked methods. Beyond the bunching strategy mentioned earlier, there are charitable giving approaches that provide tax benefits most people don't know about. Donating appreciated stock instead of cash is one of the most powerful. If you donate stock that's increased in value, you get a deduction for the full current value while never paying capital gains tax on the appreciation. Example: you bought stock for $2,000 that's now worth $5,000. If you sell it and donate the cash, you pay capital gains tax on the $3,000 gain, potentially $450 or more. Then donate what remains. If you donate the stock directly, you get a $5,000 deduction and pay zero capital gains tax. Same charity, same gift amount, significantly better tax treatment. Qualified charitable distributions from IRAs are another overlooked tool for people over 70 and a half. You can transfer up to $105,000 directly from your IRA to charity in 2026. The distribution satisfies your required minimum distribution requirement without counting as taxable income. This is particularly valuable if you take the standard deduction and therefore don't benefit from itemizing charitable donations. The QCD provides tax benefit for charitable giving even when you're not itemizing. Donor-advised funds allow bunching on a larger scale. You contribute a large amount in 1 year, take the full deduction immediately, and then distribute to charities over time. This separates the tax benefit timing from the actual charitable giving timing. If you're charitably inclined, the method of giving matters almost as much as the amount. Giving the same total amount through smarter structures can increase both your tax savings and the effective impact of your donations. These 13 moves share something in common. They're all legal, documented, and available to people at various income levels. The tax code isn't uniformly against you. It includes numerous incentives and benefits. The problem is that nobody teaches you about them. Tax software asks questions and fills in forms. It doesn't proactively suggest strategies you haven't thought of. It doesn't tell you that you should have done something different 6 months ago. It processes what happened. It doesn't optimize what could happen. Most people interact with the tax system reactively. Things happen, they report what happened, they pay what's calculated. That approach guarantees you'll miss optimization opportunities that require planning. The moves in this video work best when you think about them throughout the year, not just at tax time. The December contribution to your 401k, the decision to bunch donations, the choice to harvest losses, the timing of medical procedures, these decisions happen across all 12 months. That's the challenge. Taxes are complicated, life is busy, and actively tracking every potential savings opportunity feels impossible. But you don't have to optimize everything. Even implementing 2 or 3 of these strategies consistently can mean thousands of dollars in annual savings. Start with the moves that match your situation. If you have a 401k, make sure you're contributing enough. If you have an HSA, make sure you're maximizing it. If you have investments in taxable accounts, review them periodically for harvesting opportunities. If you have children, make sure you're claiming every credit available. Each strategy is individually simple. Together, they represent a fundamentally different relationship with the tax system, one where you're actively managing your tax situation rather than passively accepting whatever results from default choices. The difference between someone who implements these strategies and someone who doesn't can easily be $5,000 to $10,000 annually. Invested over a career, that's hundreds of thousands of dollars in additional wealth. Not from earning more, from keeping more of what you already earn. Everything in this video is financial literacy applied to the tax code. Most financial content focuses on making money or investing money, but the tax system interacts with nearly every financial decision you make. Understanding how taxes work, where the opportunities are, what actions trigger what consequences, is foundational knowledge that affects everything else. The strategies in this video aren't one-time tricks. They're frameworks for thinking about taxes that apply year after year, adjusting to your specific situation as it evolves. Someone early in their career should prioritize different moves than someone approaching retirement. Someone self-employed faces different opportunities than someone employed by a company. What doesn't change is that informed decisions consistently beat uninformed ones. The person who understands the 0% capital gains bracket takes different actions than someone who doesn't know it exists. The person who understands Roth conversions plans differently than someone who thinks traditional accounts are the only option. I made a complete breakdown of financial literacy that covers taxes alongside every other aspect of personal finance, how the pieces fit together, how decisions in one area affect other areas, and how to build a coherent financial strategy rather than a collection of disconnected tactics. If this video showed you opportunities you hadn't considered, money you could have kept but didn't, that video will give you the complete framework for optimizing every aspect of your financial life. Because here's what the tax system reveals clearly. Knowledge has direct monetary value. Knowing these strategies is worth thousands of dollars annually. Not knowing them costs that same amount every year, compounding over time. The IRS doesn't owe you education. They'll take whatever you don't actively prevent them from taking. The responsibility for understanding your options falls entirely on you. Now you know 13 specific options. Some apply to your situation, some don't. The ones that apply could save you hundreds or thousands of dollars this year alone. Most people who watch this video will find it interesting, think they should probably look into some of these strategies, and then do nothing. Life will get busy, tax season will arrive, they'll file the same way they always have, miss the same opportunities, and overpay the same amounts. Don't be most people. Pick the strategies that apply to you. Write them down. Set calendar reminders for the ones that require action at specific times. Make the calls, open the accounts, run the calculations. The tax code isn't going to get simpler. The opportunities aren't going to be advertised to you. Your situation isn't going to optimize itself. But if you take action on what you've learned here, you'll pay less in taxes this year and every year going forward. That's money that stays in your accounts, grows in your investments, and compounds toward your actual goals. The information is here. The strategies are legal and available. The only question is whether you'll use them.